ask yourself this as you look overall at the earnings picture, all the numbers we're getting out today. Do you think the economic recovery is actually in trouble? That is the question that many market participants are looking at. Some of the data that we've recently gotten has been a little bit lackluster over the past few weeks. Let's bring in the experts on this one. Barron's online stocks editor Bob O'Brien, Mark Lamkin, Lamkin Wealth Management CEO. Mark, let me start with you. You say overall that this is the Rodney Dangerfield recovery because it gets no respect, so no concerns about some of the negative data that we've gotten.
You know, the economy's always going to ebb and flow. It's never going to be a straight line recovery. The question is, does this economy and this market deserve respect? And if you look at the numbers, you got record GDP, you got record earnings in the S&P 500, great fourth quarter earnings, good first quarter earnings, auto sales that we haven't seen since 2008, industrial production, the 10 consecutive quarters growth. So the bottom line is these numbers continue to come very well. And while this market has recognized this, it's been probably the worst bipolar bull market I've ever seen. But Cheryl, here's the good news. Most bull markets since 1950, last 58 months, we're 37.5 months in. I still think we've got room to run here, but I'm cautious heading into the summer.
But yet, Bob O'Brien, here's the concern for a lot of the market participants is the fact that if you look overall at what we've seen volatility-wise and volume-wise, even more importantly, we have heavier volume on the sell days than we do on the buy days. We had lighter volume in the first quarter, numbers higher, but volume lower. And you're not liking that at all.
No, I'm not, Cheryl, because, you know, volume translates into conviction. So what it suggests is that even though the market was drifting higher through the first quarter, there wasn't a whole lot of oomph behind that. There weren't, especially individual investors. I think individual investors feel that the market's gotten taken over by high-speed trading. Computer algorithms are dominating the day-to-day action, and we're starting to see that creep back into the market with the volatility. The VIX up to 20 from a low of about 13, and we've seen more triple-digit days here in the month of April than we saw in the entire first quarter on the downside.
Mark, you know, as you look at the VIX, and this, of course, is the fear gauge for the markets, it's been jumping up. I mean, we have had a lot of action in the VIX. It's gone above 20. I mean, there is concern there. And then also, you've got the other side of the equation here, and that is with regards to earnings. If you look at the S&P 500 so far, we've had, 74 of 87 companies that have actually beat estimates. But weren't these lowered estimates, Mark?
They were lowered estimates, but the bottom line is they still beat, and earnings will still be at record levels. And I agree, volumes aren't a great sign right now, but I think it has more to do with people sitting, but you don't have a tremendous amount of sellers right now. The retail investors that I deal with are in a wait-and-see mode right now, and I think that bodes very well. Let's work through some of these earnings. Let's work through some of these issues that we're seeing in Europe. There's definitely clouds on the horizon. I get that, but the bottom line, numbers continue to surprise to the upside. Even if they're lowered, they're still surprising, and I like it.
All right, Mark, you call the market a little bipolar right now?
I do. I agree with Bob. The volatility's been up there, but the bottom line is I'd rather be drifting higher than lower, and we're continuing to do that.
Okay, Bob, let me ask you this. There's something else that we've got to kind of watch out for, and that is with regards to the French elections. I mean, it looks like we're going to be saying au revoir to Nicolas Sarkozy. He's gone. That's going to change the structure there. That's going to change kind of the dynamic that we're getting in Europe, even with Christine Lagarde and the IMF getting the funding that they wanted. I mean, it's not really up to her.
Well, and you've got political upheaval taking place across the European continent. I mean, we're seeing it in Greece. We're seeing it in Spain. Now we're going to see it in France. And political uncertainty represents a geopolitical risk that the market isn't going to like. It creates a measure of uncertainty. A lot of questions about where France is going to go with its tax rate. Is it going to be astronomically high? And the outcome of this election will go very far to determining exactly how high those taxes are going to go.
Mark, are you concerned about what you're seeing over in Europe, or do you think it's more of a U.S. story these days?
No, I definitely am concerned in Europe. If you look at 2010, 2011, you know, European fears really from 16 to 21% corrections, it all started with Europe. So I think that the way France goes, that's going to dictate the rest of Europe goes. If it's 70, 75% tax rates and just saying no to the EU budget austerity measures, I think that puts the euro on the long goodbye. And if that happens, buckle in, because it is going to get volatile.
Well, all right, buckle in, fair enough. But what about U.S. GDP, Mark? I mean, we're looking at, what, 2.5% for 2012? I mean, it's not negative, but it's not great either.
But yes, but in 2011, we have 4 straight quarters of economic GDP and GDP growth. We're at record GDP levels right now. 2 to 2.5% is not great, but it's not bad. And considering the geopolitical risk that's out there and the fear and the VIX going up, I'm comfortable with 2.5% growth. Would I rather see 3 to 4? Yes. But the bottom line is 5 straight quarters, we've grown, and we're at record earnings.
Bob O'Brien, give me a little Chinese growth. I mean, 8%. And that was a fall for them.
Yeah, that was a fall. Wouldn't we love to trade up to 8% and consider that a disappointment? But, you know, Cheryl, take a look at what the Chinese government is doing. It's trying to curb what had become a ballooning market for their housing. And, you know, they're taking proactive steps to try and, you know, take the heat off from underneath their housing market because they recognize what took place here in the U.S. 4 years ago. They don't want to replicate that experience. So on some levels, it's an artificial constraint on their growth, their organic growth. I mean, you look at their exports in the month of March, they were up over 20%. They're still sending stuff our way.
Yeah, that's why you got to watch numbers that have come out like from GE and from Microsoft and look at CAT. I mean, all the companies that have that exposure. I mean, they're U.S. companies, but they've got their exposure. Guys, thank you very much. Mark Lamkin, Bob O'Brien. Bob's going to stay with me for the rest of the hour because we've got a lot more to talk about with him.